What can be a main reason for investing in Philip Morris International? Well, I can think of two. Great brands of an addictive product, so a very wide moat, and a really nice dividend. But all of that does not make a great investment. What makes a great investment is when we can find a strong company and not overpay for it. So let's see, is Philip Morris such an investment at the current time? If you were to invest $1,000 into this company 10 years ago, you could buy around 12 shares. And today, they would be worth around $1,107. But let's not forget about the dividends. Through the 10 years, you would receive $538 as dividends. So if we add the current value of shares and the dividends, we get $1,645. So that is a gain of 64.5% in 10 years. And that is without reinvesting the dividends. Individual insiders, that is an X. 0.2% of the company is owned by individual insiders. And we would like to see this number over 2%. So unfortunately, the management does not have its skin in the game. And are individual insiders buying? That is an X. We see only sale transactions in the recent quarters. And do super investors own this company? That is a check. 7 super investors own shares of Philip Morris International. And among them, we see Terry Smith, and it makes up almost 6.5% of his portfolio. Thomas Russo with 6.1% of his portfolio, and Lee Ainsley, for whom it makes up almost 1% of the portfolio. So some meaningful investments. And are super investors buying right now? That is a check. They bought 9.5 million shares and sold 836,000 shares in the last quarter. Return on invested capital. That is a check at 35% 10-year median returns. And we want to see this number higher than 10%. So such a return is absolutely incredible. And free cash flow growth, that is an X at 1.5% 10-year compound annual growth rate. And also here, we want to see this number over 10%. So unfortunately, it does not look that good. And what do we know about net profit margin? It is a check at 24.2%, and the industry average is 23.5%. So they are just above the average, but what is important is the fact that margins in this industry are really high, and that is a nice thing to see. And now let's take a look at share buyback. It is a check with 4.3% of shares bought back in the last 10 years. It is not a massive share buyback program, but considering that they are also paying a nice dividend, it is just another way to create a little bit of value for the investors. And let's take a look at the debt. It is an X. It would take 4.3 years to pay the long-term debt with a current free cash flow. And we want to see it under 2 years. So unfortunately, it is a bit high. The dividend yield is 5.6%. So this year, shareholders should get $5.20 per every share through dividends. That is a very nice yield. But what we really want to know are answers to two very important questions. Is it sustainable and is it growing? So first, let's take a look at the payout ratio. That is an X at 86.1%, and we want to see it somewhere between 20 and 50%. So currently, they are distributing over 86% of their earnings through dividends. That is a lot. It leaves them only 14% for growth, paying back debt and so on. And it is not unsustainable, but I would feel much more comfortable with a lower payout ratio. And what do we know about the dividend growth? It is a check at 2.9% 5-year growth rate. And the dividend is growing steadily for 14 years. This is really nice news because we are not only getting the current dividend yield, but over time we can expect the dividend to get even bigger. Before we will value this company, I just wanted to let you know that if you want to get an overview of all the companies we analyzed on this channel, then for just $5 you can become a Patreon and get access to our stock ranking, which gives you this bird's eye view on all of the companies with updated valuations based on the current price. And of course, by becoming a Patreon, you are also supporting this channel, so thank you so much for that. Now, back to the valuation. Price to earnings ratio is 17.7. So for every dollar this company earns currently, we have to pay almost $18. That is less than the S&P 500 average, but it is a meaningful amount. But to properly value Philip Morris International, we will have to estimate the growth of this company for the next 10 years. And we will make 3 scenarios: low, medium, and a high one. So in the low scenario, we will estimate a growth of 1% for the entire 10 years. In the medium, 3% and then 2%. In the high scenario, 4% for the first 5 years and then 3% growth. Now, why did I use such estimates? Well, the analysts predict that the tobacco industry will grow at an annual rate of 2.5% between 2023 and 2028. And when we look at the 10-year annual growth rate of Philip Morris International, we see that the revenue went up by 0.1%, free cash flow by 1.5%, and earnings per share by 1.2%. So the low scenario predicts a slowdown of the growth. The medium scenario predicts that this company will keep up with the market. And the high one predicts that it will slightly outperform the market. And with such estimates, the intrinsic value in the low scenario is $50, in the medium scenario, $59, and in the high scenario, $65. But these are not the prices we should be looking for, because we have to always add a margin of safety. I use a 30% one, and that gives me a fair amount of room for mistakes. So with such a margin, we get in the low scenario $35, in the medium $41, and in the high one $45. And the current price is around $92. So it is all in the red. This company is currently overvalued. But even though it is not cheap, it pays a very nice dividend. So you have to decide what style of investing suits you and your investment goals. If 5.6% every year is a result you would find satisfying, then maybe it can be a good investment. Especially that the dividend has a decent chance of growing in the future, and we can also reinvest the dividends, making it even more profitable. But if you are looking for fast growth, if you are not willing to keep this company for many years, then it is most probably not an investment for you. If you enjoyed this video, you may want to check out my analysis of British American tobacco by clicking over here. Thank you so much for watching, and see you in the next one.